Hi, Vincent from 888 US Real Estate. What's going on with the Australian dollar? I mean, you know, going back in May we were saying, hey, you better do something because it just dropped below parity. And today we're looking at it, it's just dropped below 90 cents against the US. So we're going to look at that today and what that means for investing in America and how much more we got to go. And we're also going to compare the property investment opportunities in Australia versus those in the USA and look at the markets and the difference in those markets now, so you get a really clear picture of where this is going and how you can benefit from it. To start that off, I'm just going to give you a quick overview. Like in Australia, our market is stagnant after hitting, record highs. And the biggest issue we have is the low affordability of homes in this country. Housing affordability is probably one of the key factors in terms of, like capital growth. I mean, if your home's already peaking out, they can't grow much more, but if they're incredible value to wages, there's a lot more to go. Now, looking at this chart, you'll see the difference between the median prices in Atlanta, Sydney, Melbourne and Brisbane, and you can see there's a huge difference here. Like in Atlanta, your average wage in a year almost buys a whole house, where it's going to take quite a few years for the other capital cities in Australia. For investors, the rental return rate is really important because you want to be paid to invest. I mean, certainly when you invest in shares, you get a dividend, and the difficulty with Australian property is after you pay a mortgage, even at today's lower rates, you're still going to be behind the eight ball when it comes down to how much cash is left at the end of the day. And this is before rates and taxes and other things are paid. So we're looking at rental return after mortgage. In Atlanta, you've got a positive return on just the median price and the median mortgage rate, 5.26%. Sydney, Melbourne and Brisbane are all behind the eight ball before you add in rates, management costs and maintenance or any of those other issues. So you're pretty much looking at a negative cash flow for any typical Australian property that you're going to buy at the moment. The second thing that most investors want out of their property, apart from cash flow, is capital gain. You want the property values to be going up above inflation so that you're going to have more money at the end of the day than if you parked it in the bank or did something else. Now in the USA, home prices rose to their highest level in almost 5 years in May, according to the National Case-Shiller Index. In Atlanta alone, prices increased by 20.1% on average in the last year. Select recently constructed homes there are still available at half what it costs to build them. This is driven by this huge affordability of US property because of the massive amount of foreclosures that took place. That's at an end now and the economy is recovering, so now we're seeing these incredible increases in values, and there's a lot more to come. And the momentum's there, so anyone wanting to get in will make money now. You will make lots of money now in two ways, both on capital growth and on the currency move that's going on now. I can't stress this enough. We were right. We told people 3 or 4 years ago this was going to happen, that prices would double or triple or quadruple. That's happening. We also told them that the Australian dollar wouldn't stay high forever and there will be a big shift, and when it does, you'll make money on currency. That move's underway now as well. So, we were right on both counts. Now you've got to understand that currency is another big play now, and there's a huge windfall being made by investors who have got their money in the USA while the Australian dollar is sliding. I mean, if we go back to last year, we were at $1.10. We're at 90 cents now. That's over a 20% increase in the value of US assets in the space of less than a year. So you can be on that play now because we've got a lot further to go. With the mining boom ending in Australia, we're needing to go back to manufacturing and export to remain viable in the world economy. And we can't do that while the Australian dollar's so high because the value of our goods won't sell or compete in the world market. So the Reserve Bank is aggressively lowering interest rates to plunge the value of the Australian dollar lower, and they're going to keep going. We told you about this back in May, said get on this move, get your money over there because it's happening. Well, guess what? It's still going on. Now looking at this chart, we can see the historical average for our dollar is about 72 cents. We're at 90 cents now, so there's still another 18 cents before we get to our average. There's a good chance that within the next 2 years we'll see the dollar well below that. So that has a huge positive effect for anyone who's got money offshore. It has a huge negative effect on the value of things in Australia compared to the rest of the world. Now, to put this in perspective, I've prepared this chart where I've looked at the capital gain of Atlanta versus Sydney, Melbourne and Brisbane. I've also factored in the difference in currency, the currency values now. So that 20.1% increase in Atlanta has become a 33.1% increase in 12 months because of the gains in the dollar as well. Whereas if you put that into money that's left in Sydney, Melbourne or Brisbane, you're suddenly going from plus 3.23 in Sydney to minus 9.77, minus 11% in Melbourne and minus 9% in Brisbane. Now put that in context with another year of diminishing value of our Australian dollar, and we're talking about 17–18% just before we get back to average, and the Reserve Bank committed to drive the dollar down to those levels. And you could be standing to wipe out 20–25% of your existing property value by keeping your money in Australia. Whereas if you put that on the other side of the ledger in the USA, you're going to see that increase as bankable money that you can bring back later on. So when you look at it in that perspective, currency is probably just as big as the property play right now. As this momentum of the Australian dollar keeps going lower, if you've got US property, you're going to receive rent in US dollars. What it means is that the net yield on your initial investment is going to go up, because when you convert the dollars back to Australia, they're worth 13–20% more than they were when you invested in the first place. So you're getting an immediate increase of return, and that's going to keep going up, which is a fantastic thing. Now, what's also going to happen is that the currency movement will keep adding to your capital gain. So when our dollar hits the average rate of 72 cents or below, you've got an opportunity to sell your home and make an extra 20 or 30% on top of the already outstanding growth we're experiencing right now. I know, because I've been talking to a few people, some of you might be wondering whether you've missed the boat and it's too late to get over there. I just want to show you this snapshot that I took from the market today. On one side we got a house I've got listed that's for sale now for $84,000. It's a new renovated 4-bed 3-bath home built in 2004 versus an under construction brand new home around the corner which is priced at 160 plus. So 84,000 versus 160, and when you look at them, they're very similar, almost identical product. So look, we can get you into an existing as new renovated home, rent it out, and there's still a lot of growth there. In a year or two, if these homes aren't worth 120 to 150,000, there's something wrong with the world. Right now you can make a lot of money. You really want to get on this boat because everything is moving at an incredible pace.